Shane, you can start now.
This meeting is being recorded.
Good evening, and thank you very much for joining us today. We've got a very exciting session lined up for you this evening. We've launched a new fund. It's called the Access Floater Fund. It's an open-ended debt fund, and the hallmark of what we're doing today and what we intend to do today is to try and explain to you how a floater fund works and why it is such an important launch for us, given that the context of the debt markets have evolved quite materially over the last 6 months. If you were to look at where we stand today, we are now in by all estimates in a rising rate environment. And in such an environment, the way investors have been participating in the debt markets has to also evolve so as to get the best out of their debt investments. With us today, we've got R. Sivakumar, who's the head of fixed income at Axis Mutual Fund. He comes to us with about 20 plus years of experience, and he's basically the brains trust at the fixed income desk. And Siva hopefully will give us a little more color at a very granular level about how he intends to kind of manage the strategy, as well as how this makes a lot of sense for your portfolio. Good evening, Siva. Welcome to the show.
Thanks, Shane. Good afternoon, everybody, and thanks for being here. As my objective over the next few minutes is to just sort of introduce this asset class called floating rate instruments and the floater fund. But before we jump into what a floating rate fund is, first of all, to get a sense as to where we are in terms of a macro economy and interest rates, because a floating rate, or any kind of investment product, you need to understand the context in which that fund is being proposed, and therefore it makes sense for us to take a quick look at what's going on in the macro environment. Over the last year and a half, pretty much the entire discussion that we've had has revolved around COVID, and it's no different this time. And yet, where we are today, we are really at what looks like the fag end of a very large second wave. And fag end matters because it's more like that we are exiting the second wave of COVID than where we were, let's say, back in February or March when we were entering the second wave. The second wave of COVID has also been quantitatively and qualitatively very different from the first wave. The chart on the left shows a number of cases in a red line in the first wave and the second wave, and you can see that the second wave completely dwarfs the first wave. So quantitatively, it is much larger than what was the first wave of COVID in India. Qualitatively too, it was very different. In the first wave, it was mostly urban, or I would say predominantly. The second wave has spread as much to rural areas. The first wave in many parts of the country affected largely the poor in urban areas. For example, there is some statistics to show that in a city like Mumbai, more than 60% of the cases in the first wave happened in the slums. In the second wave, something like 80-90% of the cases happened in high rises, where which is more the middle class and the upper classes. And this change in COVID has happened for a couple of reasons. One, of course, is a simple fact that those who got infected the first time around, well, they didn't get reinfected, or by and large, they didn't get reinfected, and therefore the second wave affected people who were not infected in the first wave. That is to say, more of the high rises, the rural India, and so on and so forth. But it's also important from a different perspective, which is that the consumption boom that we saw as we came out of the first wave, as unlocking happened after the first wave, we actually saw a consumption boom, and consumption boomed both because of rural consumption, which was not affected much by COVID, but also held up by urban consumption. This time around, it's very important to see how consumption holds up, given that larger, the consuming public, which is relatively well off in urban India, and more broadly the rural India, has been affected by COVID. So it's going to be very interesting to see how that happens. Nevertheless, early indicators are that as we come out of the second wave, we are actually seeing a significant improvement in demand conditions and therefore broader macroeconomic economic conditions. The chart here shows FMCG sales, but that's actually reflective of broader situation where we are seeing various parts of the economy start to do well. In fact, it's not just the consumer part of the economy which is starting to recover. Shane, next slide, please. It's not just the consumer part of the economy. I'm sorry, they're having a little bit of difficulty moving. Yep, thank you. But actually, we see businesses too start showing signs of getting better. We see data from purchasing managers, which is a survey of business owners, and which seems to suggest that while there has been some slowdown, it's nowhere near as bad as last year. Tax collections remain reasonably healthy, and other data such as project implementation, thanks to government spending, rail cargo. A lot of these things suggest that things aren't as bad this time around as they got when the first lockdowns hit in April, May last year, or March, April, May last year. Now, moving on. The reason I'm spending so much time in understanding the growth environment and the sort of post-COVID situation is that the Reserve Bank of India has been maintaining an extraordinarily low interest rate policy for the last, let's say, nearly 15 odd months. Some of you may know that the overnight interest rates are currently close to 3.25%, which is the all-time low, and it matches the low we saw after the global financial crisis back in 2008-2009. Such low interest rates are normally not consistent with the kind of inflation we are seeing today. For most of financial year 2021, we saw inflation above 6%. And even the last two inflation prints in May and June of this year, we have seen inflation above 6%. If inflation rate is above 6%, it doesn't make much sense that the interest rate is at 3.25%. The only reason that interest rates can remain so low in a relatively higher inflation environment is because growth is very, very weak. If growth comes back, there is no logic for interest rates to remain so low. And inflation is not just an India phenomenon. It's happening in the rest of the world. In fact, if you look at worldwide, the commodity prices increase. Shane, can you go back to the previous slide, please? Previous slide, please. Thank you. The commodity price increase that we have seen in terms of increase in prices of oil and other commodities has happened because the world, much of the Western world especially, has moved into a kind of a post-COVID phase. We have seen the US, Europe, UK, Canada, many of these developed economies now hitting 50 to 70% vaccination rates. And therefore, demand is coming back robustly in many of those economies. I mean, it's not a worldwide thing. We are obviously seeing Asia and other parts of the world still catching up or still in their second or third waves of COVID. So it's not across the board great. But the point is that globally inflation is picking up. So you have a situation where, I'm not sure some of you may have noticed the US printing inflation numbers of 5% or more, in India, of course, 6% or more. And with these kind of high inflation prints, it only makes sense that interest rates now have to start going up. The markets aren't going to wait for RBI, and market interest rates have already started to move higher. So this is sort of the movement in market interest rates for different points of the yield curve for the last 6 months, since the start of this year. So December 31st to 30th of June. As you can see, a large part of the interest rate increase or yield increase has really happened in, let's say, bonds which are, say, 3 or 5 years, where yields have risen by more than 50 basis points. Other parts of the yield curve, not so much. We've seen essentially flat to marginal increases. But why we see relatively small increases in rates at the shorter end of the yield curve, for example, 3 months to 1 year, is largely because this segment is controlled by the RBI. There's a lot of excess liquidity. Banks are sitting flush with funds, and there is little incentive for banks to start raising rates, or indeed market interest rates at this end of the curve to start moving up. Longer bonds is a different story. As markets preempt the RBI, so 5-year or 10-year bonds or 15-year bonds actually see more of a to price higher interest rates to come. By some measures, you can argue that the kind of yields that you're seeing today on 5 and 10-year securities, so 5-year Government of India bonds at about 570, 10-year Government of India bonds at about 610, suggests that the markets have already are well beyond the 3%, 3/4% overnight rates that we see today. So in a sense, we are seeing a dichotomy of sorts in the market. Why is this again important? It's because when we are building our portfolios, when we are making investment decisions, how do we make an investment decision in a low interest rate environment is really what this is all about. Because overnight rates are so low, as I mentioned, closer to 3/4, and because there is so much of excess liquidity in the market, it has become impossible for investors to put money in short-term debt instruments, relatively safe debt instruments, and yet beat inflation. And this has been the
This meeting is being recorded.
rise in yields potentially can create significant
Mutual fund
challenges
investments are subject to
for
market
longer term
risks.
bond
Read
investors.
all
So
scheme-related
how do we
documents carefully.
reconcile this thought process? We are seeing a rise in interest rates. I'm sorry, guys, we are seem to be having some challenge. Wait for a moment while while we get our presentation back on. Thanks, Shane. Can you full screen that and next slide, please? COVID world, where the Fed has already started moving up the so-called dot plots, which is in essence their some of the Fed members forecast about future interest rates. They're expecting to start increasing rates. We are seeing that across many other parts of the world, and certainly among the emerging markets, where you're actually already we have started seeing interest rate increases in some parts of the world. So globally interest rates are going up. India may also join that in the next few months. Our expectation is that the RBI will certainly need to start raising rates over the next few months. The whole process of interest rate normalization could very well take 12, 24 months or more. So this looks like a medium-term process of interest rate increases and interest rate normalization. So whatever investment strategy we put together in debt markets right now has to really take into account the fact that rates are likely to go up over the next couple of years. Next slide, please. So coming to what then makes sense for making investment decisions, and we've looked at over the last interest rate cycle, many interest rate cycles, just to look at illustrations of what happens when interest rates start to go up in India and abroad. To illustrate a large rate increase scenario in India back in the 2008 cycle, at the bottom of the interest rate cycle in 2009, as I mentioned, the overnight interest rates were about 3/4%, which is roughly where we are today. The 2-year G-Sec yields moved up in the next 2 years from about 4.5% to above 7%. This is a time when overnight interest rates moved up from 3.25 to about 6%. So you had a very, very large increase in overnight interest rates, and short-term yields moved up. 10-year government securities yields moved up from about 5% to 8%. So across the yield curve, we saw a very large increase in yields as the economy turned around from the bottom of the global financial crisis. So this kind of illustrates what happens when you have a sharp or a strong economic recovery, which leads to RBI increasing interest rates. We've also looked at a scenario: what happens if the US starts increasing interest rates, and that comes as a shock. This is illustration of the taper tantrum which happened in 2013. So if you look at what happened in 2013, short-term interest rates, in this case illustrated by the 1-year T-bill, went up from about 8.25% to 10.5, 11%. And 10-year G-Sec similarly went up from about 7.25% to about 9%. So the entire yield curve moved up very, very sharply in response to a global event. So whether that is a recovery in India leading to RBI increasing interest rates, or whether that's a global recovery leading to the US changing its monetary stance, we need to be prepared for a scenario where yields can rise, and that's something I think we are is something what we want to do at this point of time. Try to build portfolios which are resilient to rising interest rates. So that's really where floating rate bonds come into their own. Now, let me just take a moment and explain what a floating rate bond is. And also what's important is to understand what's the difference between a fixed rate bond and a floating rate bond. A fixed rate bond, it just pays a fixed rate of interest through the life. So let's say if you're buying a 5-year bond at 6% per annum, every year you make 6% per annum. At the end of the period, you get the 6% and the maturity back. If you have a floating rate bond, which is linked to a benchmark, for example, the overnight rate or a treasury bill rate or any other interest rate in the economy, then as interest rates go up, the interest on the bond increases. So illustratively, we've shown a bond here, which is on the right, where let's say you have a bond which is a 3-month treasury bill plus 1.2%. So if the 3-month treasury bill rate is 4.5% today, then the coupon on that bond is 5.7%, 1.2% higher. If the rates were to fall, then the coupon also falls. And if the rates were to rise, then the coupon would rise. Now, this is interestingly, the behavior here is very different from a fixed rate bond where the coupon remains the same. So what really happens is that in a rising interest rate environment, the fixed rate bond actually starts to depreciate in value. Many of you may know that there's an inverse correlation between yields and prices of bonds. As yields on bonds rise, prices of bonds fall. A floating rate instrument does not have this behavior, because as yields in the economy rise, the coupon on the floating rate instrument rises. Therefore, there is much smaller impact on the price of the bond. Sometimes there is virtually no impact on the price of the bond. So this is really interesting. That is a nice way of capturing a rising interest rate scenario. Naturally, it doesn't work in all cycles, and if interest rates are going down, obviously the floating rate bond will also, yields will fall. So that's something to keep in mind. It's not a one-side story that, but over a cycle, you actually can participate in a floating rate bond without suffering the same kind of volatility of a fixed rate bond. For example, a 5-year floating rate bond would have much lower volatility than a 5-year fixed rate bond. And that's the important thing to keep in mind. It reduces the volatility, and the yield or the coupon changes in line with the interest rates in the economy. Now, floating rate bonds are issued by many issuers in India, government being the largest issuer. They have a lot of issuances linked to the treasury bill rate, typically the 6-month treasury bill rate. There are many corporates who issue. However, the market for this total issuance, government plus corporate sector, is actually not big enough for us as mutual funds to participate. So therefore, we also participate in what's called synthetic floating rate instruments. In a synthetic floating rate instruments, what happens is that we buy a fixed rate bond, and then we enter into a contract with a counterparty such as a bank or another financial institution to exchange fixed rate for floating rate. So I own a fixed rate bond, and I enter into a contract to pay a fixed rate to that entity, and they in turn will pay me a floating rate. So in effect, the total combination of the two, the fixed rate bond plus this so-called swap, it's a swap of coupons, converts my bond into a floating rate instrument. So this is a way by which we can actually increase the pool of investments in the portfolio. So I don't only have to buy direct floating rate bonds, we can also buy fixed rate bonds and swap them into floating rate instruments. The swap market in India is very deep. In fact, it's larger than the government bond market, which is the largest fixed income market in India. It's a very, very deep and liquid market. And in doing so, what actually happens is it improves the liquidity of the portfolio. Floating rate bonds are much less traded than fixed rate bonds. So therefore, having fixed rate bonds with swaps means I own two liquid assets compared to relatively less liquid floating rate instruments. So this is the way we actually intend to build a portfolio. We estimate that approximately, about 30 to 40% of the portfolio we could actually buy fixed rate instruments. And in fact, probably 50% or more of the portfolio could be this so-called synthetic floating rate instruments, where we have a fixed rate converted into a floating rate. In combination, we expect that therefore more than 65-70% of the portfolio will be invested in floating rate instruments. That's really how we intend to build the portfolio. I'll also take a moment and illustrate what happens when we have interest rate increases. So this is a scenario analysis. This is not expectation. So don't take this as that this is exactly what's going to happen. But just take a look at a scenario analysis. We've looked at 3 fixed rate bonds here and 1 floating rate bond. The floating rate bond in this scenario behaves very differently from a fixed rate bond. So let me illustrate it to take one part of this. Let's say the situation where interest rates are going up by 100 basis points in the next 12 months. We have just for this illustration, we just assumed that goes up at 25 basis points every 3 months, and the 3-year floating rate bond is linked to a 3-month reset frequency. So that also rises with this the same frequency. If you look at a 3-year AAA bond versus a 3-year floating rate bond, today the yield on the 3-year fixed rate bond is better than the 3-year floating rate bond. But in the next 12 months, if interest rates go up by 100 basis points, then the return on your 3-year AAA actually comes down. A 3-year fixed rate bond actually comes down because the coupon is 5.2. It's definitely better than the floating rate instrument, but the price of the bond falls down. So the total return actually comes down to below 3%. And the floating rate instrument, on the other hand, because the coupons are going up, the return goes up from 4.6 to closer to 5%. If interest rates go up even more, for example, if rates go up by 200 basis points in the next 12 months, 50 basis points every quarter, the 3-year AAA bond practically return goes very close to 0, less than 1%. But the 3-year floating rate bond, the return goes to 5.3%. So you see the divergence in performance between a fixed rate bond and a floating rate bond, with the floating rate bond doing significantly better when rates go up. I will also say here, if the rates go in the other direction, then obviously fixed rate will significantly outperform. So in a falling interest rate environment, it makes sense to be in fixed rate environment. So take a case of what happened between 2018 and now. In 2018, short-term AAA, 3 to 5 year AAA bonds were yielding 8.5 to 8.75. They came all the way down to 4-5%. A massive move down in yields. Huge amounts of gains to be made across portfolios. Everybody is happy. In fact, I go so far as to say that it looks like that was the easiest way to make money. Short-term, low duration, relatively low duration, highest quality, typically AAA public sector, PS, typical, banking and PSU type of names that everybody was happy with. So highest credit quality, relatively low duration, and among the best performing. So you had a combination of what's best performing with low risk. But the view from 8% to 4% is very different when your starting base is at 4% or 5%. You are not likely to see yields drop from here by 300 or 400 basis points. And the balance of probability is that rates are going to go up from here. So therefore, from here on, we are not expecting the same kind of outperformance that these short-term AAA assets have done. And we should be more wary about where we are investing in today's market environment. And that's the reason why today we want to sort of get into this floating rate strategy. Shane, next slide, please. The last part is a little bit important, which is to understand what's going on in the non-AAA space. Over the last couple of years, the credit markets in India have taken a big pounding. It's very difficult to imagine this, but ILFS default was nearly 3 years ago in August, September of 2018. We are approaching the 3rd year anniversary of that. And 2018 and 2019 was really terrible for credit markets in India. 2020, as we entered the pandemic, the expectation was that it's going to be just as bad. And yet, in the second half of last financial year, when we were really when people expected that there would be a lot of downgrades, defaults, and remember that in April of last year, one mutual fund had shut down some credit schemes, etc. So there's a lot of panic in the market, belief that there's a lot of downgrades, defaults yet to happen. But in the second half of last financial year, CRISIL, one of the largest rating agencies in India, saw significantly more upgrades than downgrades across its portfolio. For every 100 downgrades, there were 133 upgrades. This was completely at odds to what was expected. Why did this happen? It happened for a couple of reasons. One, because we saw a lot of government and RBI steps. The government came out with partial credit guarantee schemes and other schemes to support the corporate sector. The RBI came out with schemes such as targeted long-term refinance operations, which again supported the market, moratoriums, etc., which made sure that there was no panic in the credit markets. More importantly, many of the credit, the non-AAA corporates learned their lessons from 2018 and 19 and had built up a lot more resilience going into 2020, which means they had more cash on the balance sheet. They were a lot less reliant on short-term financing, and that really helped them weather 2020 much better. And as we go into the current year, it does appear that most of these corporates continue to show that kind of outperformance. This is also being reflected in markets. The spread of AA over AAA has compressed a lot since April, May of last year, when there was a lot of stress as the pandemic set in. These spreads are still relatively attractive, and I believe that that's going to be a space where we want to have some allocation. So we don't want to make this a pure AAA portfolio. We have a situation today, Shane, next slide please, where 5-year AAA bonds are, let's say, close to 6%, 580 to 6%. 2-year AA bonds are roughly about the same yield. I would say here, in this case, relatively the better or lower yielding AAs, that is the better performing AA corporates. As I mentioned before, in a rising interest rate environment, the longer duration bond carries more risk. So if you have two bonds which have similar yields, in this case a 5-year AAA and a 2-year AA, in a rising interest rate environment, the 2-year AA is where you would want to be, assuming that the credit risk is manageable. So if you are careful about the kind of credit risk that you run, the kind of names that you have in your portfolio, then in today's environment, I think it makes a lot of sense to have some allocation towards credit. The underlying quality is holding up, as I said, in some cases actually doing much better than what was expected, and the yields in the market are relatively attractive. So the opportunity is to really add some of this short duration, and it's important, short duration credit names to the portfolio. Our expectation is in that in our portfolio, we would want to run approximately an 80-20 mix with a minimum of 80% in AAA. Could be higher, of course, so 80 to 100% in AAA, but up to 20% in AA bonds, where we believe that we can get some kind of reasonable spread. So this also takes into account the fact that we wouldn't want to be in very, very low yielding. We want to have low risk through a floating rate strategy, but we don't want to be completely out of yield as well. So that's really it in terms of what this whole strategy is about. We've just launched this fund this week. It closes next week. Aditya on my team runs this, is going to be running this as a fund manager. And Shane, next slide, please. Just sort of a quick summary of what we think this should be. As I mentioned before, the portfolio is really biased towards quality. We want to be 80% plus in AAA and equivalent securities, AAA, A1 plus, etc., and up to 20% in AA bonds. We're not really going down the curve, so this is not about single A and triple Bs and so on. Really in AAA and AA, the highest quality issuers. In terms of investment suitability, we think it makes sense for investors who are looking for 12, 18 months or longer. As I mentioned before, the interest rate cycle this time we expect to be 12 to 24 months or longer. So therefore, aligning with that, it makes sense for investors who have a minimum of 12, 18 months, but I think comfortably it's a 2-3 year kind of holding or longer story as well. In terms of the average duration of the portfolio, we expect to be between 6 months to 18 months. This is what's called a net duration, so it takes into account the duration reduction using swaps. And that's really it. I think we are very, very happy to be launching this at this point of time. We think we're at a very crucial point of time in interest rate cycle, and therefore it makes a lot of sense. So what I will do here is, I think Shane's been accumulating questions. There's a chat box, I think, that we can take questions. Shane, can you just introduce that whole concept? And also, I believe we have a number and email address right next to this presentation, so you can use that to get in touch with us for more information. But right now, we're still around, so I'm very happy to take any questions. It just doesn't have to be only on this fund. If you have any questions on the debt markets or our strategy, happy to take that as well. So Shane, please take it away.
Yeah. So we've got a few questions already, and thank you for that, Shiva. That was a very, very good, very simple to understand explanation on the fund. For the participants today, there is a chat box right at the bottom which you can use to ask any sort of questions that you would like either Siva or myself to answer. And I think we've got a few questions. I've noted a few down. Let me just take a crack at it. So we've got the first question, very basic, I think, is what is the type of investor, Siva, that should ideally use this type of a product? If you could just give a broad gambit of what are the typical type of investors that would participate in this fund.
So we see this as we are kind of addressing a couple of important investor needs in this. One is for where you are looking to just park some cash for short to medium term. So obviously this is not a liquid fund, so we're not expecting that investors should come with an horizon of days or weeks, but rather if you have an investment horizon, as I said, 1 year or longer, I think it's still a good solution for just parking some cash. So the cash part of your portfolio, we know that overnight and short-term interest rates are very low, and there's a way to pick up some yield. Then there's an opportunity here. For example, if you are today looking at portfolio strategies in the money market equivalent categories such as low duration funds, ultra short-term funds, etc., I think this can be a good replacement for those in terms of where we expect yields to be slightly better, as well as reprice higher as rates go up. So it's kind of a proxy for some of these cash-like funds in the portfolio. The second is to look at this as a part of a wider fixed income portfolio. I'm sure you already have a lot of investments which goes into regular fixed rate instruments, whether that's through mutual funds or otherwise. So how do you hedge yourself across a market cycle, right? So if you're looking at an allocation to bonds, you want to have some of your allocation to floating rate instruments simply from a perspective of hedging yourself against fluctuation in interest rates over an interest rate cycle. So it's not only about timing. Therefore, it's not only about why invest in floating rate bonds now, but as part of a core allocation to a fixed income portfolio, how do you manage the risk between your existing portfolio and a floating rate fund? Now, I cannot advise the percentages. But idea is that a floating rate strategy kind of complements an existing fixed rate strategy. It's also why, for example, in some of our existing portfolios, for example, we use floating rate instruments in much the same way to manage the risk, right? So it's not that we don't, it's not that I'm saying that floating rate funds are the only way. Our existing funds will also use swaps, will also use floating rate bonds. And much the same way in your own portfolios, you can look at managing your duration or managing your risk account.
Sure. So in a sense, whether regardless of the age of the investor or whatever his need, maybe a floating rate strategy could have a small portion of his allocation or could work in the overall portfolio mix, right?
That's right. I think whatever your allocation is, and typically we say that when you're younger you have more equity, when you're older you have more fixed income. But whatever your fixed income portfolio is, carve out within that. Or carve out within your cash part of your portfolio. So all of your portfolios have some percentage which we are keeping aside as part of our sort of cash holdings. We keep it for emergency cash reasons, for STP into equity, or for any other reason where we hold cash in our portfolios. This could very well be part of that portfolio.
Yeah. So that's a very important point, I think, for investors who are even looking at doing STPs into equities. A floater strategy might work well, given that in a rising rate environment, you would incrementally keep getting higher and higher carry in some essence, right?
That's right. I think that's the whole point. I think like I said, it's an alternate to any ultra short low duration money market strategy. It depends on your risk profile and what exactly you're looking to do. And the longer you look at it, let's say over the next 2 years as rates go up, I think the more it makes sense to have some kind of floating rate bonds in your portfolio.
Sure. And Siva, if I may ask you, what are the typical risks that you see in a floating rate strategy? What are the sort of risks that investors should be ready to handle if things go south?
Yeah. So like I said, in terms of portfolio quality, we are going on the side of quality. So we're not really going down the credit curve, etc. So I'm not really worried about credit quality necessarily in a portfolio of this sort. What really happens is the risk to this, the whole thought process around interest rate normalization, both in India and rest of the world, is that COVID is finally getting beaten back in some way. Now in India, we have seen the second wave waning. we are seeing a significant acceleration in vaccination campaign, and there's good evidence now to suggest that we could be 30-40% of the population vaccinated by the end of this year. So and that add to that the existing infection which is already spread to a large percentage of the population, there should be what's called herd immunity developing, and therefore the risk of a third wave or other is relatively limited. This is a core thesis, and in fact the Western world is also behaving in the same way, that you have high degrees of vaccination, which means the risk of any future COVID waves are relatively limited. Despite all this, it's still possible that you can have a shock to the economy, that you could have COVID come again, you could have some other shock to the economy, and rates could remain lower for longer, or indeed rates could go down. So when you look at a floating rate fund, at the end of the day, one of the core things is that we expect to make more money if rates go up. So what happens if rates go down, or if rates remain where they are? Then you don't expect to make that additional rate. Well, if rates remain where they are, you'll make similar returns as compared to any other money market or short-term instrument. So be it. You're not losing money. If rates go down, certainly these instruments likely to underperform. So keep in mind that in a floating rate instrument, the upside happens when rates go up, and downside happens when rates go down. Timing wise, we believe we are on the upside track right now, so it makes sense for us to do this at this point of time. But if you were to take a 5 or a 10-year view, be prepared at some point of time in the cycle, rates will obviously go down.
Yeah. And to that extent, I think even the portfolio will be actively managed to kind of navigate this cycle.
That's right. So one of the things that we didn't really discuss about is how this duration is going to be managed in the range of half a year to 1.5 years. That's the current range that we are contemplating anyway. The idea is that why should there be a duration? You're saying it's a floating rate instrument. Why should there be any duration at all? But there is. A government bond, for example, is a 6-month treasury bill plus a spread, which means a government bond typically has a 6 months duration. Right? Even a government floater at least has a 6 months duration. A corporate instrument may have floating resets of 3 months, 6 months, 12 months, or whatever the case may be. Therefore, it has residual duration. When we create the synthetic floaters, we are buying fixed rate bonds and using so-called swaps to reduce the duration. There may not be exact date-to-date matching between the date of the maturity of the bond or the duration of the bond and the duration of the swap, again leading to some duration. And lastly, floating rate instruments comprise of 65% plus of the portfolio, and potentially there is therefore 30-35% of the portfolio, which is normal fixed rate bonds, which again cast. So there is some duration going to be there in the portfolio at all points of time. So this is where duration management really comes into itself. So obviously, if rates are going to go down, we have the flexibility to increase the duration, which is subject to bounds, and that allows us to capture at least part of that down move in rates. And if rates go up very aggressively, we obviously want to be at the lower end of that to allow more of the upside through the floating rate part. So this balance between managing the duration and the floating rate mix is something that we intend to do quite actively.
Okay. So Adesh has a question. He says that in the event that we anticipate a rising interest rate environment, obviously the government also knows that it is going to see rates rise in the near term. Why would it, or why would any other borrower basically issue a floating rate bond?
Right. So when you look at floating rate instruments, typically a lot of these issuers are also financial institutions. So when you look at, if you have a housing loan, for example, the housing loan rate is a floating rate, or if you have a bank loan, that bank loan is linked to an MCLR type of, therefore typically a floating rate. So the loan side of a balance sheet of a financial institution or a bank is typically largely floating rate. So from these financial institutions' perspective, issuing floating rate bonds is essentially hedging their risk. So financial institutions, banks, and such entities are natural issuers of floating rate bonds. The government is actually trying to diversify itself. So large percentage of the government borrowing is actually fixed rate. So only a relatively small percentage is floating rate. And they would have benefited in the last couple of years as rates have come down. So they are also looking at it strategically, not looking at managing the next couple of years. So by having a portfolio of both fixed and floating rate bonds, from their perspective, they are also hedging their borrowing costs.
Okay.
Other corporates do this for various other reasons. As I mentioned, many companies, so we, for example, have, to give you an illustration, certain contracts on the infrastructure side which are linked to the RBI bank rate, which means the rate of return earned by that entity is linked to the to a floating instrument, which is a bank rate. And as the bank rate goes up, their income goes up, and as the bank rate goes down, their income goes down. So they also again are issuers of floating rate instruments because it hedges that risk. So for many issuers of floating rate, it's not about taking the call that whether rates are going up or down now. It's more of a strategy of their balance sheet management.
Okay. Fair enough. Fair enough. So, so we've got a few HNIs on the call as well, I believe. And one question is that a lot of these guys also issue floating rate instruments directly to the public, right? What is the difference between participating in a floating rate fund like us and maybe buying a floating rate instrument directly on the market?
Not much different by buying a fixed rate fund versus a fixed rate bond. And if you're buying a mutual fund, you get diversification, you get active management, and you get long-term indexation if you hold for beyond 3 years. So long-term capital gains with indexation if you hold for beyond 3 years. So the similar things happen here. It is actively managed portfolio. You get much better diversification, and yeah, if you are holding long enough, then obviously there's a tax advantage in a mutual fund. If you are less than that, of course, the tax is about the same. But the real story is the fact that it is a lot more diversification and active management, which I think plays a lot of role here. Like I said, the secondary market for floating rate bonds is not necessarily very liquid, and therefore, if you buy a floating rate bond on your own and you really need an exit, it's not going to be always easy and not necessarily at the price which you're comfortable with. In a mutual fund, of course, it's an NAV, and therefore you always know exactly what you're getting. Essentially, you outsource your liquidity risk to the fund.
Sure. I'll take a few questions on the economy, if you will. So we've got PN Murthy who asks us, is there a relationship between stocks and bonds? Given that stocks are at all-time highs, what is your view on the bonds collapsing as well?
I don't think there is any very good relationship between stocks and bonds. There's a lot of theory that if interest rates go up, then equity market valuations must come down. I am not a big subscriber to that point of view. I mean, if you remember, 2003 to 2008, interest rates in India went up from about 4.5% to 9.25% or something like that. And equity markets had perhaps the best run outside Harshad Mehta. And if you look at even more recently, again, whenever we have had rates go up, we've not had any instances where equities have collapsed because of interest rate increases. Because you got to remember, underneath an interest rate increase is the fact that the macroeconomy is doing well. The RBI or any central bank raises rates when economy is doing well, and that's typically also a point of time when corporate earnings are rising, and usually that's good news for stock markets. So if there is this relationship, automatic assumption that stocks and bonds have to work opposite each other, I don't think that's quite true. So let's not necessarily link the two together. Having said that, of course, equity markets have run up a lot over the last year or so. So therefore, there's a lot of concern, and I think especially about valuation and so on. And our house view is that there's a possibility that you might see some what's called a time correction if it comes to it. We're not really believers of a large crash in the market. Underlying earnings momentum continues to be strong, certainly for the kind of companies that we look at, the high quality, high growth companies. So we're not really seeing that as a huge risk in terms of large sort of market correction. It can always happen, but it's not what we are expecting. But if you're really looking at equities at this point of time, perhaps you might want to have a slightly longer horizon to ensure that you are not really suffering from the valuation issue that we are today.
Yeah.
Now, so that's it's not a direct link. I hope I answers the question.
Yeah. Could the third wave have any bearing on a strategy like the floating rate fund? Would that be a positive?
So if you look at what happened in the second wave, so if you look at what the RBI signaled between January and April of this year, they started signaling tightening of liquidity and raising, without mentioning it, but they started talking about signaling that rates eventually have to go up. And then in April and May, they had to backpedal because COVID second wave hit, where it was a big, massive rise in cases. And in May and June they announced some relaxations, and in June policy they stayed pat. So so if you have another resurgent wave like second wave, then again RBI will hold rates. It's not likely that they will cut interest rates. So the rate cuts, I think, are very, very unlikely. I mean, the second wave, which was much bigger than the first wave, didn't see any interest rate reductions. But if you have a third wave, then the process of interest rate increases will get delayed. So that means interest rates will remain low for longer. So that essentially means a floating rate strategy and a fixed rate strategy will perhaps, in the short duration space, will perhaps behave similarly. So The outperformance of a floating rate strategy comes when rates go up. So that may not happen immediately if there is a third wave. As I said before, the evidence for today so far is that the risk of a third wave is relatively small. It's not a zero risk. It's still there. But again, some of you may have seen this news report that in Delhi, where they did a seropositivity survey. So this is where they test a sample of the citizens for antibodies against COVID. They found some 80-85% of the people tested had COVID antibodies. Now, if you believe that 80-85% of the people already have had COVID or have been vaccinated, that's only two scenarios in which you get antibodies. If I already have 80% of the people already vaccinated or have COVID, where is COVID going to come next? Where's the third wave going to come? Who's it going to infect? The COVID 1 to COVID 2, what happened was COVID 2 were infections largely were people who were spared in COVID 1. But if between COVID 1 and COVID 2, if we have a majority of the population, let's say 80 was excessive, let's say 50% of the people are infected. And out of the remaining 50, a reasonable chunk, let's say 40% of that 50% will get vaccinated. We're assuming 40% of people in India will be vaccinated by the end of this year, half of whom have already had COVID. So, double counting doesn't help. Let's say, so another 20. So if you say 50% are already got COVID, another 20 you add to that, so that's 70% of the population who have either had COVID or vaccinated. And the risk of a third wave is low. It is still there, but the risk of a third wave being as large of a second wave is relatively low. It's again, that is one of the risks we must be prepared at this point of time, that if we have another wave of COVID, the entire process of interest rate normalization will get further delayed. But it's only a delay. It doesn't change anything.
Yeah. So that actually ties in very well with this next question from George. Basically, he asks, what happens if rates don't move up as much as we've anticipated? We've I think budgeted for around 150, 200 basis points of move in yields. What happens if there's no move? What happens to floating rates?
Yeah, it's like a coil spring. You can keep it tight, you can keep it tight, you can keep it tight. At some point of time, the whole thing will just pop, right? So we saw this happen in the past also in India, where the RBI has tried to fight this whole rising interest rate scenario by keeping rates low, by holding a very tight control on rates through open market operations, high liquidity, etc. We saw this back in 2008, 2009, 2010. The RBI kept pumping liquidity into the system, kept rates very low. Some of you may remember Subbarao, who was the governor of RBI at that point of time, using words like taking baby steps towards interest rate normalization. And then suddenly, as inflation spiked and as they just had no option but to hike very aggressively. And by 2013, in fact, we were in the middle of this whole taper tantrum and had to do a lot of defensive steps. Now, I hope RBI learned the lessons from 2013 and is not interested in repeating those lessons. So I think even if the RBI holds rates for longer, it's under the realization that the end point is not going to be very different, that rates have to go up. As I said at the start of this presentation, you cannot have 6% inflation and 3% interest rate. That doesn't make any sense. You either bring inflation rates down, and the RBI's target is 4% inflation rate. Their forecasting is 5% inflation rate. So let's say if they manage to get inflation rates down to 5%, the overnight rate still needs to be 5% or more. So from where they are today at 3/4, we are still talking about 150, 200 basis points rise in rates over the next, maybe it takes 2 years, maybe it takes a little longer. But that end point where you have a positive spread over inflation is going to happen. The more you delay this process, the more the risk that we are not actually at 5, but we are actually at 6 or 7 or higher.
Sure. So I'll rattle off a few answers to some product-related queries. Milind asks, is an SWP available? Yes, Milind, it is. Just like SWP, there are all the other systematic transactions that are available to you. You have an SIP, you've got an STP, you've got an SWP, you've got the entire gambit. Thomas asks if there is an exit load or a lock-in. No, there is no exit load for this fund. You can come as you please, go as you please. No lock-in again. Shirish Pal asks, is this product for a short-term investment or a long-term investment? I think Siva already alluded to this. It is for an investor across the age groups, for across tenures. You can pick and choose as you please.
So Shane, just a moment. When I come to that, our ideal horizon is, we would recommend that you stay for a year or longer. So while we are looking at this product as relatively low risk, the target duration of this fund, which is 1 year, give or take a little bit, means that still you must match. Keep that in mind when you're making an investment decision. So please look at this as a 12, 18
Right.
months of longer holding period.
Right. Fair point. Sorry about that. Shiva, a question on the product in terms of volatility. If you were to bucket this, if you were to look at our entire bucket and then look at floater separately, what sort of volatility do you see vis-a-vis some of our other products?
No, as I discussed, the net duration of this fund is expected to be in the 1 year ballpark, give or take, and probably in the current scenario a little over a year, but broadly in the range of half a year or a year and a half. That means it kind of sits in between, on the one side a money market and a low duration fund, and on the other side a short term fund. So it's kind of in between the two. So look at this as a relatively conservative or less volatile than a typical short term fund or a banking PSU or a corporate debt. That category, less than that in terms of volatility, equivalent or slightly more than a low duration or a money market.
Sure. There are a few questions on documentation and how to invest in this fund. There is a number that is there for investors to call. That's our helpline. The priority team is standing ready for any queries that you may have on documentation. You can invest at the NFO through our website or through the mobile app, details of which can be taken from our priority team. A gentle reminder: if you've got any further questions, do write them to us in the chat box. Siva, if I could come back to you in terms of true floaters, currently, what is the investment? What is the amount of stock that is outstanding in the market today? If you could just give us a sense.
So that's a tough one, really, because it's a class where actually the issuance is going up constantly right now. So it's a tough one to give an answer. I actually don't have the number out of the top of my head. But as I said, the largest issuers are the government and the financial institutions who are constantly issuing new stock. It is a relatively small part of the overall debt market. So it's like single-digit percentages of the total debt market.
Sure. Okay, so I think that's all the questions we've got today. Thank you so much for participating. Thank you, Siva, once again for addressing the audience. As usual, please do write to us for any sort of queries that you may have on all of our products offerings, and we also publish a lot of collaterals with regards to the latest updates that our fixed income and the equity team have for us from time to time. Do have a read. And thank you very much once again. It was a pleasure. Just to close this out, the Axis Floater Fund has the NFO opened on the 12th of July and runs up till the 26th of July. Happy investing. Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.